Happy Monday, everybody. Welcome to another episode and a new week of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. And first up, China should unleash a new wave of massive, and I mean massive, scale investment to revive domestic demand and ensure steady growth, argues Yongding, a former advisor to the People's Bank of China. His call marks a rare departure from the prevailing view among economists that consumption must become the nation's main growth engine, and that stimulus is dangerous as the nation has very little fiscal space left and a mountain of debt. Speaking at the Bund Summit in Shanghai, Yu proposed a sweeping infrastructure investment program for China's next 5-year plan, beginning in 2026. He likened the initiative to the 4 trillion yuan, $562 billion stimulus rolled out during the 2008 global financial crisis, an effort that accounted for roughly 12% of GDP at the time. Quote, "In a situation of inadequate demand, infrastructure investment delivers immediate economic results," end quote, Yu said, warning that direct measures to stimulate consumption, quote, "may not be enough to fill the gap," end quote. A package of similar scale today would total about 16 trillion RMB, $2.2 trillion, potentially lifting growth amid a slowdown in both consumer spending and business investment. Though the 2008 plan helped China avert recession and mass unemployment, it also inflated a property bubble and left a lingering debt burden, lessons that have made policymakers wary of another spending surge. Indeed, regular viewers know that China has limited fiscal space, with many local governments in a state of de facto bankruptcy. These calls for a titanic level of stimulus, despite the crisis levels of debt, shows just how desperate and concerned some China elite policymakers and commentators have become. Regular viewers also know that much of the investment that we have seen in recent years that has been directed by the state, especially into infrastructure, has gotten very little bang for its buck, and has also fueled China's overcapacity issues, as credit was redirected from property after the deflation of that bubble back in 2001 into advanced manufacturing. Yu, however, believes the economy's current challenges warrant bold action. With export growth fading and global demand uncertainty, he sees infrastructure and high-tech investment as essential to boosting household incomes and sustaining long-term expansion. Key projects could range from energy and water infrastructure, such as the $167 billion dam in Tibet, to digital networks, pipeline upgrades, and service sector facilities like elder care. His views contrast sharply with those of leading economists such as Stephen Roach, former Morgan Stanley Asia chairman and current People's Bank of China policy advisor Huang Yiping. Both stress that China must strengthen consumption and avoid repeated debt-fueled growth patterns, especially given existing industrial overcapacity. Recent data underscore the urgency of the debate. Year-to-date investment fell for the first time since 2020, while retail sales slowed to 3% growth in September. Deflationary pressures are mounting too, threatening corporate profits and household confidence. Despite doubling consumer subsidies to 300 billion yuan this year, the impact on spending has waned, and misallocation of funds has surfaced. China aims to double its economy by 2035, requiring annual growth of around 5%. Yu argues that such a pace will be sustainable only if investment regains its central role. Quote, "Countries with the highest consumption rates are often trapped in poverty," end quote, he said. Adding, quote, "It's more important to grow the overall economic pie," end quote. Meanwhile, while we're on the economy, today, Monday, saw the publication of China's industrial profits by the National Bureau of Statistics, giving policymakers a rare piece of positive news. According to these numbers, which are official, so we do take them with a grain of salt, China's industrial profits surged 21.6% in September from a year earlier, the strongest gain in nearly 2 years, as factories ramped up production and factory gate price declines eased amid Beijing's campaign to curb overcapacity. The result followed a 20.4% jump in August. For the first 9 months of 2025, industrial earnings rose 3.2%, with manufacturers posting a 9.9% gain that helped offset steep drops in mining and gas production. Analysts attributed the rebound to stronger external demand and moderating price declines, supported by targeted government stimulus and regulatory tightening. Yongding of the National Bureau of Statistics said the figures reflected the efforts of, quote, active and promising macro policies, end quote, and rapid growth in high-tech and equipment manufacturing. Still, David Chu of Bloomberg Economics cautioned that profit growth, quote, far outstrips, end quote, improvements in revenue and costs, suggesting underlying demand remains weak. Other economists warned that the industrial rebound may prove short-lived without stronger domestic demand. Next up, China's overseas lending in RMB, Renminbi, its currency, is rising sharply as Beijing accelerates its push to internationalize its currency and reduce reliance on the US dollar. Over the past 5 years, external RMB loans, deposits, and bond investments by Chinese banks have quadrupled to more than 3.4 trillion yuan, 480 billion US dollars, reflecting a coordinated strategy to build a more multipolar financial system less vulnerable to Western sanctions and dollar-based disruptions. Recent sanctions by the EU on Chinese banks accused of aiding Russia's war efforts have reinforced Beijing's determination to promote the RMB as a safe alternative for trade and finance. For China at least. Quote, from China's perspective, settlement in RMB is important because it shows that no matter what happens, it can still trade, end quote, said Adam Wolf of Absolute Strategy Research. Data from China's State Administration of Foreign Exchange reveals that the external fixed income assets of Chinese banks have doubled in a decade to 1.5 trillion US dollars, with nearly 1/3 now denominated in RMB. According to the Bank of International Settlements, overseas bank lending in RMB to developing economies rose by 373 billion US dollars between 2019 and 2023, marking a, quote, turning point, end quote, away from the dollar and euro-denominated credit. Countries such as Kenya, Angola, and Ethiopia have converted dollar debts into RMB, while Indonesia, Slovenia, and Kazakhstan have issued or announced plans to issue RMB bonds. Trade finance has been a major driver of this trend. The RMB's share of global trade finance quadrupled in 3 years to 7.6% as of September, making it the second most used currency after the dollar. China has also expanded its network of offshore clearing banks and currency swap lines, and its cross-border interbank payment system, CIPS, now processes more than 40 trillion RMB each quarter, even as RMB transactions on the SWIFT network decline, suggesting a migration toward China's own financial infrastructure. Beijing is also addressing the structural barriers that have long constrained the RMB's global role. Hong Kong, a key testing ground for liberalization, has introduced a so-called roadmap to deepen liquidity in RMB assets, building on the success of the Stock and Bond Connect program. New policies allowing foreign investors to use RMB bonds as collateral in China's interbank repo market mark another step toward greater accessibility. While analysts agree that Beijing is not seeking to dethrone the dollar, its progress is undeniable. As Citibank's Paul Smith put it, quote, all the elements that would make a much more rapid internationalization work are falling into place. End quote. Now, if you want to be on top of all things China through grounded and sober analysis, as we move into this new period of competition and uncertainty between China and the West, consider subscribing to China Update. Hit the bell notification icon and you will be. If you're getting some value from today's episode, it's a huge help too if you can just hit that like button. And for those who want to go the extra mile and help me keep China Update financially sustainable, I rely primarily on your support, the audience's support to keep going. Patreon and Buy Me a Coffee links are in the description below. For everyone who supports the channel, my deepest appreciation and thanks. And finally for today, we end with the global trade war. Chinese equities advanced on Monday today amid growing optimism that Washington and Beijing are on the verge of sealing a comprehensive trade agreement, potentially ending months of renewed tariff threats and export tensions. The onshore CSI 300 index gained as much as 1%, while a gauge tracking Hong Kong-listed Chinese firms rose 0.5% in early trading. Technology and semiconductor leaders led the rally, as investors priced in expectations means of easing trade frictions between the world's two largest economies. The uptick followed weekend announcements from senior trade negotiators who said the two sides had reached consensus on several thorny issues, ranging from export controls and fentanyl regulation to shipping levies. U.S. Treasury Secretary Scott Bessent said on yesterday, that U.S. President Donald Trump's threat to impose 100% tariffs on Chinese goods was now, quote, effectively off the table, end quote, signaling a major step towards detente. Markets are now turning their focus to Thursday's planned summit between Trump and General Secretary Xi Jinping, where the two leaders are expected to finalize the deal. Quote, overall, the near-term reaction may be cautiously optimistic, end quote, said Delin Wu, strategist at Pepperstone Group, adding, quote, any gains may be measured, more indicative of improving sentiment in risk assets than a dramatic market surge, end quote. According to officials, the talks held in Kuala Lumpur over the weekend produced a preliminary consensus that could lead to renewed US soybean sales to China and a deferral of Beijing's sweeping rare earth export controls. Bessent added that Washington could maintain its own export restrictions, but welcomed China's apparent willingness to delay its rare earth measures for a year while reassessing them. A broader framework is also taking shape. Bessent hinted that the pending Trump-Xi agreement could extend a tariff truce, resolve the dispute over TikTok's ownership, and ensure the continued flow of critical rare earth materials vital to semiconductor and aerospace industries. The leaders are also expected to discuss global security issues, including the war in Ukraine. The diplomatic thaw comes after months of escalating rhetoric, during which Beijing tightened export rules and Trump countered with threats of sweeping new tariffs. Signs of progress have boosted global risk appetite. Safe haven currencies slipped, and Bitcoin extended its 4-day rally. As Trump put it during the ASEAN meeting in Malaysia, quote, they want to make a deal and we want to make a deal, end quote. We'll be following the space closely to see if a deal is reached, and if so, for how long it will last. After all, the broader Cold War between these two powers is only set to deepen. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.